in which we will be covering basically the technical aspects, that is introduction to market-based instruments, that is futures, options, and difference between the two. What are the decisions that one need to take before you hedge, that is calculating your risk exposure, hedge ratio, operational capital requirements, etc. So today we have Mr. Sumit Gupta from McDonald Pells. I think sir doesn't need introduction. He's been very kind enough to be part of our this series, and creating awareness on these derivative contracts and how these are beneficial to the industry at large. But still, I would like to introduce you all to my guest today. Mr. Sumit Gupta has 17 years of experience in commodity business. He has worked in Cargill and Olam before starting McDonald Pells Asia office. Sir is the head of business for Asia at McDonald Pells, invested in active-driven businesses, and has a proven track record of starting and scaling businesses. Sir, thank you so much for taking your time out on this Saturday morning at 10 o'clock and imparting your knowledge to all our guests today. I hand over the stage to you, sir. Thank you so much. I would request all my participants to make it a very interactive session. You can ask your queries in between to sir, and I'm sure he will be very happy to clear your doubts. Thank you, everybody.
Good morning, everyone. Thank you, Gopalini, first for such a kind introduction. I will say during pandemic, especially during this phase, the most boring thing to attend is webinars. And second, if it comes about training or teaching or giving a classroom learning, it becomes even worse. So my job today is not only to pass on what we know, but it's more important that all of us stay together for, let's say, next 90 minutes. And the idea of the presentation is, as mentioned by Puleni, is to make it as interactive as possible, because the kind of doubts or which we will bring will make only presentation richer, because we cannot cover all the aspect into the slides, and the good questions makes presentation better. First, and thank you very much for taking time out on Saturday morning. It's always tough. What I have done, I have divided this slot of 90 to 100 minutes into 4 parts. In first 15 to 20 minutes, I will like to talk about the market environment and why risk management is necessary. In next 30 to 45 minutes, we will cover the presentation. And maybe in the last part, we will take the questions related to presentation or related to markets or whatever we want to discuss. The intent of the entire discussion is providing information, and there is no intent of guiding anyone to take positions. And it's a disclaimer, I will put this way, and I have no proprietary position in any of the products, so there is no conflict of interest involved. So I will say what we are living through is a very historic time when you consider the human civilization, especially year 2020, which was a period when we saw the pandemic. It has changed the trajectory of human growth, because human society was growing at a particular pace, and pandemic came and it changed at the pace at which human society was growing. Okay, and now what does it mean? It means we are living in a society which has an elevated risk to health, to financial instruments, to businesses, and to a set way of thinking which we were having before pandemic. So it is a catalyst which we should all respect in a way which is going to guide our behavior for next 20 years. And before pandemic, all of us were talking about bearish commodities. There is nothing happening in commodity segment. Metals are going down. Crude prices were there. Nothing was happening there. But post pandemic, after demand shock, I'm re-emphasizing, after demand shock, we saw a big increase in prices in virtually every commodity. Is it the factor of weather? Is it the factor of demand or supply? I will say it is a mix of everything. And especially the commodities, because commodities requires continuous investments from the people who are extracting commodities either from Mother Earth or who are producing commodities. And because of the pandemic and initial demand shock, the initial investments into the commodity sector stopped, and which has led to the demand shock. When demand came back, nobody was prepared to take care of that demand. Crude prices went up, which we are going to live in an elevated crude price scenario for years to come. I will talk about the green environment, green commodities, and why it is impacting crude. And because of the crude, the entire energy sector become vibrant. What is corn? Corn is nothing else but energy. It is carbohydrate. And that is where the commodity segment became quite interesting, because now it is there a positive
So one
margin for
second.
it.
One second. Sir, your volume is low, it seems, sir. If you can just probably put your speaker closer.
Is it better now?
Yes, sir.
Okay. So because of this, the commodity segment become quite interesting, and agri sector also become very vibrant. In last 1 year, we have seen almost 100% price increase globally on corn, soybeans, vegetable oils, and other related commodities, which has direct or indirect impact on a country like India. Now, specifically, now when we are combining this COVID commodities and India, we are a country with 1.38 billion people. And once you have a population base of 1.3 billion people, आपको continuous consumption के लिए we need commodities. And that is where India, which was a big producer and consumer of commodities and big importer of veg oil, pulses, and now we are turning to be exporter of grains, has find itself caught in this pandemic. And that is where especially the processor and consumers got shocked ki why there is so much volatility in commodity prices, why it is impacting me, why my entire budget got whacked, and how I prepare myself to take care of these risks so that going forward I don't get caught in this kind of situation. Why I am saying this year is in particular is very important from hedging, understanding of price risk management. Because अभी तक क्या होता था, we were only concerned about price risk कि भाव में तेजी हो गई, भाव में मंदी हो गई. But now this year, especially in soybean, people got concerned with the supply risk कि क्या हमको material मिलेगा या नहीं मिलेगा. Price becomes secondary, and especially when we enter into a situation where you can get impacted by the supply risk as a consumer or a processor, it becomes imperative for us to cover our supplies and risk our and manage our price risk. So hedging does not become a choice, but it becomes a compulsion. Second point I want to mention, it is people say there is a risk in hedging. There is risk in everything. There is, but if you don't hedge, you are running the maximum possible risk. By doing hedging, you are actually trying to protect your risk. That takes me to a very colloquial statement that what is a hedge? I will put it in a start of the presentation. Hedge is nothing else but a boundary. Jैसे when we construct home, we put a boundary, we call it hedge. And this word is taken from the same side. That means we try and protect ourselves. We try and define our area that I'm ready to lose this much money or I want to protect myself against this risk. So that is hedging. All of us do hedging of some kind in our life. We buy insurance. That is a hedge. We try and buy put options. That is a hedge. We try and secure ourselves against our career risk by getting more education, by getting more certificates. That is a hedge. Hedge is to protect yourself against any adverse outcome which is against your business risk. And as of now, whatever I have said, कि global prices have gone up, inflation बढ़ गया है, उसके कारण markets are more volatile, has no meaning for a person who is hedging his commodity. He should not care what is the direction of the market. He should only care that what risk I need to hedge. Added knowledge of the market only helps him to take his or to improve the timing of his hedge or to get out of the hedge at the optimum time. But as a consumer, to take an excuse कि मेरे को global markets का नहीं पता है, global markets changes too frequently, has no meaning to hedging. It is for the people who want to make money by the direction of the market. A hedger does not care कि market ऊपर जा रहा है या market नीचे जा रहा है. A speculator cares कि market is going up or market is going down. A hedger cares whether he is able to pass on his risk which he intend to pass, whether it is price risk or he wants to cover himself for the supplies of the year. And that is the reason I have taken maybe the first 10 minutes to define the macros of the presentation. That as a participant, as a consumer, as a processor, हमारे लिए कोई ऑप्शन नहीं है कि हम हेज नहीं करें, बिकॉज आज हम प्राइस रिस्क रन कर रहे हैं, आज हम सप्लाई रिस्क रन कर रहे हैं, रिस्क ऑफ रनिंग आउट ऑफ सप्लाईज, व्हाट हैपन इन सोयाबीन मील. We have to counter the government policy, we have to look towards what variables can change, and that is where, to sleep peacefully at night, we have to understand the functioning of futures, options, how we can hedge it, how we can reduce our risk in the transaction, and more importantly, how we can do it by knowledge, by informatively, not by chance. Because the people, and that is the first slide, and that's where we come to the first slide of the presentation, that says luck is what happens when preparation meets opportunity. And that is where we don't have to become lucky, or we don't have to say that we are unlucky. We have to say we are prepared to take care of the market, we are prepared to stand against the movement of the market, or we are prepared to face whatever market do in front of us. What is more important for us is to be prepared. And that is where I will say last year people didn't see the soybean prices going up or going down. That is their trading call. But if a consumer or a processor has not taken a supply hedge against it, then he was not prepared. And that is where he can call himself unlucky. He should not say that prices have gone against me. One should say we were not prepared to take care of that, because we already had the hedging instrument available on exchange in soybeans. What is more important for us is how we use it. So in this presentation, we are trying to cover the risk exposure. What is risk? I will try and explain the mechanism of risk, how we should understand risk. Okay. Then the second part, uh, all of us think in a very straight line fashion. अगर ये हुआ तो ये होगा, ये होगा तो ये होगा. आपका view क्या है prices पे? भाव ऊपर जाएगा, भाव नीचे जाएगा. What I want through medium of this presentation want to say that right way of thinking is probabilistic thinking. Never think in straight line. Always think what is probable. What are the chances of that thing happening? How God is Lady Luck is going to smile on me, how I'm prepared to take care of it. And that is where the probabilistic thinking come into picture. Consistency of risk assessment are the first tools to say कि हमको क्या hedge करना है. First thing, we should know how to understand risk. If we don't understand risk, we cannot hedge risk, because we can only hedge risk. That is where in the risk literacy, risk assessment comes first, and that thereafter comes the tools to take care of it. Then we have covered the various instruments, because in certain commodities we want to hedge, we want to understand what is basis, how we can hedge it, how it impacts us. So in next 60 minutes or so, I will try and walk you through the various aspects of the presentation. I will dwell on every topic in depth and without mathematic notations. There will be mathematical notations on side of it, but my intention is not to explain anything in mathematical terms, because if we start putting it in mathematical terms, half of the people lose interest. I am a practitioner, and my idea is that you should, at the end of the presentation, should be able to practice it. And you should be able to use these tools irrespective of your mathematical knowledge, or because it should become intuitive. आपको देखते ही ये समझ में आना चाहिए कि ये क्या हो रहा है and how it can impact me. So we have covered this. Okay, why we want to do a presentation on risk management? No entrepreneur will wake up in morning and say, I want to take risk. He will always say how I can minimize my risk. He will always come and say, okay, I know what is the risk in my business. Tell me who is ready to buy this risk away from me. And that is where the risk management aspect come into picture. And higher is your risk management skill, more consistent will be your reward. Why we are saying this? Because stock market, valuation companies, PE funds, consumers, customers, they value the companies which are consistent. If you have a consistent price, consistent quality, consistent offering, and consistent returns. And that is where, if you have good risk management practices, your company can grow faster than the companies whose P&L is more volatile. And that is where consistency is the key. And to understand the concept of consistency, we have to understand what is risk. Risk is probability. The Greeks used to call it as goddess Fortuna, or they used to call as the mother of chance, because things, there is nothing which is straight line, that two will come after one and three will come after two. It is a circle. There are a lot of variables, and each variable can impact you in different way. And that is where it is said, whenever you see future, it changes. Because as soon as you touch future, it has many variables. It takes any other variable. And that is where the people who ask, कि आगे भाव में तेजी है मंदी है, they do the most injustice to themselves, because that view holds only for that moment in time. As soon as we get into a new situation, which may be 30 seconds, 1 second later, that view has no meaning, because new situation takes market into a new direction. What is more important for us is to define the macros and understand the variables around it. And that is where we have to understand risk. Risk is where your potential outcome can change from your expected outcome. आप ये सोचते हैं कि सोयाबीन का भाव 40 रुपया से 50 रुपया जाना चाहिए, दैट इज योर एक्सपेक्टेड आउटकम. वो 100 रुपया चला जाता है, इज द रिस्क. कैन इट गो? यस. कैन इट गो टू 30 rupees? Yes. So it is a difference between your expected outcome and the real outcome. And sometimes we say, what is the difference between risk and uncertainty? Risk is something which we can measure, which we can understand, and that is where you can manage risk. You have the history of prices, so you know कि भाव कैसे move हुआ है, and that's where you can analyze the risk. Uncertainty, where you don't know anything. Will it rain? It's rain is also, you can put a risk and numbers around it. Will there be a bomb attack in Afghanistan today? We don't know. It's an uncertainty. It may happen, it may not happen. So the events where you cannot put a mathematical number around it is more are defined uncertain events. Where you can risk define it in mathematical numbers, you can define the probability of it happening, is the risk. So it is a question I want to ask each one of you, and I will stop here for 1 minute, and I will ask you to request you to analyze it for yourself. These are 5 companies, A, B, C, D, E, and these are their return on capital or returns on profit, or return or their profitability for last 5 years. Okay, company A makes 12, 10, 12, 14, 16%. Company B makes 40%, 12%, 55 minus 30 minus 13. Company E makes 10%, loses 50%, again loses 40%, makes 100%, and then makes 44%. So which company are you going to invest your money in? That's the first question. Which company is the one where you are going to for sure lose money? And third question, which is the riskiest company of all? So I will request each of one of you to answer this question for yourself. Then I will come to the answer of it. Okay. I will stop here for maybe 15 seconds. If somebody wants to answer it in chat section, or somebody wants to answer this question, I'll be very happy. So first question, which asset you will invest your money in out of A, B, C, D, E? If somebody wants to answer. Okay, so let me go to the, so please look at this problem. These are the various returns. If you look at the return of all these companies, it is around 64%. All the companies more or less have made 64%. Again, I'm not going into percentages. I've just taken a simple average. I've just totaled it, just as a layman, just to explain it in a very simple terms. I don't want to go into higher mathematical concept because then we will end up confusing everyone. So return of almost every company is around 64%. But does this mean all these companies have same return? Answer is no. If you look at company A, it is consistently making 12.8% every year, approximately 12.8% every year, with a potential change of 2.5%, 2.2% every year. That means the returns of this company is extremely, extremely consistent. And you will always like to invest money in a company whose returns are consistent. So A is the safest company to invest money. Only going by the historical numbers, only going by the metrics which we are discussing. While the company C is consistent in losing money, that is also okay. You can short this company. You know, the company is very consistent in losing money. You have to make money either by going long or by going short. So you don't care the direction of movement. You should care about the consistency of movement. So company C is equally safe to invest money by shorting it. But the company D, it also gives you 12.8% return annually. But look at this company, it has a standard deviation. That means that this return can be minus 90% or this return can be plus 100%. Will you like to have a product in your composition जिसका price can change 100% की इस साल price उस commodity का 50 रुपए है, अगले साल 500 रुपया भी हो सकता है और next year 10 रुपया भी हो सकता है. Will you like to have that product? Answer is no. And that is where it is the riskiest product to get into. And that is where we have to understand always, not by कि पिछले साल उस commodity ने कितना return दिया है या पिछले साल वो कितना तेज हो गया है, but we have to see it over the years कि उसका risk assessment क्या है, उसका standard deviation क्या है. Standard deviation is a measure of volatility जो आपको ये बताता है कि मीन के ऊपर वो चीज कितना ऊपर नीचे जाती है, कि उसका मूवमेंट, उसका रिस्क या उसका डिविएशन ऑन मीन कितना है, कि वो कितना अपने मीन्स के ऊपर या नीचे बदलता है. और वो सबसे एंड इट इज द मेन मेजर ऑफ रिस्क. इसीलिए जब भी हम कमोडिटीज के प्राइसेस को या स्टॉक्स के रिटर्न को एनालाइज करते हैं, हमको हमेशा ये देखना होता है कि वो कितना वॉलेटाइल है. जो कमोडिटी या जो प्रोडक्ट जितना ज्यादा वॉलेटाइल है उतना ज्यादा रिस्की है. एंड हायर द रिस्क, द मोर इज द रिक्वायरमेंट ऑफ रिस्क मैनेजमेंट टूल्स. अगर आपका किसी चीज का स्टैंडर्ड डिविएशन 0 है तो आपको उसको रिस्क मैनेजमेंट करने की जरूरत ही नहीं है. दैट मीन्स उसका भाव नहीं बदलता है, वो हर साल 10% से बढ़ती है. सो यू कैन बजट दैट इन एंड मूव फॉरवर्ड. बट जो चीज वॉलेटाइल है, जिनका स्टैंडर्ड डिविएशन हाई है, आपको उनको रिस्क मैनेजमेंट करने की जरूरत है, क्योंकि आप उनको एक्यूरेटली बजट नहीं कर सकते हैं कभी भी. And that is the difference between consistency and randomness. And that is where even randomness is a very high degree of order. So that is where we don't have to fear from anything. कि यार ये मेरे को समझ में नहीं आ रहा है, it is changing too fast, why it is changing. Only request is you should divide that problem into smaller parts. Look how I can manage that risk, how I can first understand that risk. And that is where we come to this matrix, which starts with the identification of risk. Then we see what is the kind of risk which is there, how I'm going to mitigate that risk, and then you put a plan around it. Especially for the commodities where your input, for example, I am Parle-G, I'm Britannia or Parle, who is manufacturing biscuits. My end product price is fixed, that I have to sell biscuit for the year at 5 rupees per pack. But wheat price this year has gone up from 16 rupees to 22 rupees. Sugar prices have gone up from 28 rupees to 40 rupees. अगर मैंने अपना प्राइस को अच्छी तरह रिस्क मैनेज नहीं किया है, हेज नहीं किया है मेरी डिमांड को, that means my entire profit is gone. So that is where, especially in the product जहां आपका end product price fixed है and raw material price variable है, commodity volatility can evaporate all your profits. There are certain segments जहां पर आपका output price भी variable है, input price भी variable है. There you cannot get into long-term contracts without having a proper risk management policy. And that is where, especially if you want to get, especially poultry sector, अगर हमको eggs का या chicken का 6 month supply contract करना है, या we know और from our experience कि हमारी end product की volatility इतनी है, and to cover that मेरे को अपना इतना रॉ मटेरियल को हेज करना है, इट इज वेरी इंपॉर्टेंट दैट वी अंडरस्टैंड व्हाट काइंड ऑफ रिस्क एनवायरनमेंट वी आर गेटिंग इनटू, and and we manage that risk environment appropriately. Otherwise, our end product prices may go up, but our input supply prices may go up faster than that, and that may take away all our profits of the company. So हमको हमारी supply, हमारी demand क्लियर अंडरस्टैंडिंग की बहुत जरूरत है। सेकेंड पॉइंट मैं एक बार यहाँ पर दोबारा री एम्फोसाइज कर रहा हूँ कि ये जो पूरा प्रेजेंटेशन है, वी आर डिस्कसिंग मोर अबाउट द प्राइस रिस्क, बट स्पेशली द पोल्ट्री कंज्यूमर प्रोसेसर दिस ईयर हैज सीन सप्लाई रिस्क। आपके लिए तो कोई ऑप्शन ही नहीं है, यू नीड टू हैव कंसिस्टेंटली अ सर्टेन लॉन्ग हेज on the board, so that आपको, if you need 3000 tons of beans soybean meal every month, you need to buy at least 50% of it, that is maybe 1200 tons of beans on board to cover your supply risk. That means that price kuch bhi ho, you will get the supplies. And that is where it is very important for us to understand what is the exact environment we are living through. We are going to live through a very volatile environment for next at least 2 to 3 years, because global environment of weather patterns are uncertain. It has been consistent for last 7 years. And as we are getting into the volatile environment, it means enhanced price risk. I don't want to scare, but I'm just telling the reality of the environment that we are living through. And this is the risk assessment framework. There are a lot of risks which are very common, but they are big risks, like the price risk. And that is where we cover them by hedging. There are certain risks which are severe, but they are very rare, like COVID. It happens maybe once in 100 years, a global pandemic, or natural disasters. So we cannot plan against it. But whenever something like this happens, we need to have a good risk philosophy that, okay, most of the companies have reduced their business size during COVID times. Hunkering down is a good policy during these days. Every industry can have their own risk assessment and risk philosophy to counter this kind of events. Then we have consistent risks which are very common but very mild, like currency fluctuation every day. But we go and hedge our currency, right? This is to take care of the mild and common risk. And this is usually done through the hedging policy. And there are mild and rare, export policy, new government, new policies. We have to be vigilant about it because they are slow changes. They give you time, you can understand, you can adapt about it. So we need to put our risk in either of the categories that we have discussed. And once we know whether it is a severe risk, if it is a severe risk, can we plan against it or we cannot plan against it? If it is a severe risk, can I hedge against it or I cannot hedge against it? If it is a common risk, okay, how, because if it is a common risk, then you need to surely have a hedging policy against for it, because because if because if you lose 1% money every day, you just need 100 days to lose your capital. So for against the common risk, we need to have a good hedging mechanism or hedging policy. And for the let's say rare risk, we need to have a risk philosophy that if something like this happens, how we are going to counter it. We should not be surprised by it, or we should not fear out of it. And since this presentation is centered more about discussing how the futures options, which are the two major tools that we have discussed for the risk, because till now I have dominantly focused on the risk assessment, risk analysis, understanding risk, having a thinking around probability, that what can happen, what is the probability of it happening. I want to take you through that these option tools are not new. In year 500 BC, which is 2500 years back, okay, there was a philosopher by name of Thales. He was walking on the roads of Greece and he fell down. He was a stargazer, or let me put it this way, he was an astrologer. And somebody made fun of him that those who look at stars always fall in ditch and you cannot make money in your life. He said, what? And what, by his knowledge of astrology, he made the weather patterns and he said, next year in Greece, it's going to be have bountiful of rains. And when you have good rains, you have good olive crop. And he didn't have that much money, so he couldn't buy the oil press machines, but he raised certain money and he took the option, call option, or you can say he did the tolling arrangement with all the major oil processors in Greece. And that year they had a huge olive crop, and there was a big demand of oil presses, or what do you call, the processing plants during that time. And he made huge amount of money. And that is where it is to highlight that you can use futures and option to manage your risk, to make money. But it is important that how you understand this, and these instruments are not new. They are with us right from the start of the civilization. People are using it in various ways. People are using this in their colloquial or the local ways. What is more important is to understand the terminology that we are building up and how the mathematics around it is building. And once we are building the science of derivatives, we are also building the science of hedging around it. Why I am emphasizing on these 2 points? Because as risk is going to go higher, and as more and more derivative products are going to come, as a processor, as a user, आपका risk भी बढ़ने वाला है, because market is going to become more volatile. You can say it's a catch 22 situation. Okay. And that is where non-understanding or not using these tools is not going to stay as an option. आपको ये tools का understanding is a must, and you have to use it in whatever way. Let me start it with a very simple word, that what is price? People say define price, because entire risk management, price risk management is centered around one simple point, that is price. What is price? What is a fair price? What is a right price? What is a wrong price? It is a sentimental price. People can use various terms around it. Okay. But it in very simple words. Okay. Price is something. How much of it? A price is something for which somebody is ready to pay a commodity for. Okay. And it depends on only two factors, supply and demand. So we need to understand the supply and demand of commodities, which in very simple term, how much of it is there in the market and how badly people want to buy it. How much soybean meal is there in the market and how badly and how early processors or cattle feed manufacturers or poultry feed manufacturers want to buy it. If supply is more, price goes down. If demand is more, price goes up. There is no reason for any manipulation, any speculation, any activity or what we call as hoarding or any these. I mean, you cannot manipulate a big market. Market in itself is a signal. NCDX or trading platforms are usually messengers that tell you कि future में क्या होने वाला है. Don't blame them if prices are going them up, or don't blame them if prices are going down. They are not doing anything. They are just reflecting the sentiment of the market, and market is stronger than each one of them. Most of the time we think कि our view is a right view. Please don't make strong views and keep adaptable views. आपका view should be more flowing than water, but you should have conviction in your view at that moment. But you should not think कि मेरा view जो price के ऊपर है, price वैसे ही जाने वाला है. No, because we are impacted by thousands of parameters, not one. And that is where none of us can analyze all of it. And somebody smarter in the market can see what is coming in future, and he takes his call accordingly. And that is where to say price is something, we should not have a very rigid view of price. We should have a very flexible view of price. And it depends on the propensity of both buyer and seller. And future market is a place where both buyer and seller met for a promise to deliver or buy something in future. Okay. And that is where the role of future contract becomes important. And why it is important? Because it provides you a hedging platform. A hedging platform is a risk management tool that is designed to limit your exposure. Okay. And it is done in a scientific manner. For doing risk hedging, you don't need, again, I'm mentioning, you don't need to have a view on the market. You just need to have an understanding that what risk I need to protect myself against. If you're a speculator, then you need a price view. Then you need to know the direction of the market. The objective of a hedger is not to make money. His objective is to reduce risk by using either future or option. Future you can do or use from the long side or short side. Options, there are two instruments which are call and put. You can be a call buyer, you can be a call seller, you can be a put buyer or a put seller. Okay. Generally, the people who hedge, they buy calls, they buy put. The people who speculate, they usually write calls or write puts. And it is generally for the protection for the future movement in price. Okay. Uh, uh, and the objective of a hedger is to protect himself from the volatility. And speculator use this price volatility to make profit. Okay. And that is where, as I mentioned in the slide first, that as a hedger, you don't need to have a view on the direction of the market. You need to have a view on on the policy, on your requirement rather than on the direction of the market. And that is where I believe it is very important for all of us to differentiate between hedger and speculator, because without that we cannot get into market, because if our objective is not clear, we will end up messing up with it, because then we'll start taking speculative bets when we are required to hedge our risk. Please, when our objective is to hedge, go out there in the market to hedge, not to speculate. Then don't worry about the direction of the market. Worry about what you need to do. What is your objective? Okay. And that is where we come to another important point. What is a commodity spot price? Okay. It is a price at which deal is done in the spot market. आज अकोला मंडी का क्या भाव है? Is your spot price. Okay. Or commodity spot represents the price at which commodity is being traded at the current price in the marketplace. While हमने जो future market की बात की, it is a price which is trading for the future date and delivery as per the set specification and the contract terms. So difference between the spot price and the future price is your basis. That defines कि आपका what is the delivery dynamics, कि उसका cost क्या है. And जब हम फ्यूचर प्राइस की बात करते हैं अगेंस्ट द स्पॉट प्राइस, इट हैज टू पार्ट्स, contango and backwardation, carry or discount. जब what happens when future prices, okay, are in carry, what happens, that means your next month is in carry to the current month. And in backwardation or discount, your future month is at a discount. The price of the future month is lower than the current month. Why it can happen? Because at the time of harvest, आपको लगता है next month crop आएगी, भाव नीचे आ जाएगा. Contract is in backwardation or contract is in discount. When contract is in carry, carry is nothing else but your cost of capital plus warehousing cost plus warehousing cost. And people डू आर्बिट्राज अगेंस्ट इट. जो लोग ब्याज बदला करते हैं, डिलीवरी डायनामिक्स प्ले करते हैं, व्हाट दे लुक एट देयर हेजर्स. दे सी कि मेरे को फिजिकल में क्या मटेरियल मिल रहा है, फ्यूचर में मेरा कॉस्ट ऑफ कैरी ऐड करके क्या है, एंड दे डिलीवर इट अगेंस्ट दैट. And they hedge the future contracts or sell the future contract against their deliveries. And they capture the difference between the future price and their cost of carry plus the spot price. Why it is important to understand? Because never see कि future का price तो 100 रुपया ज्यादा है. Always see in percentage terms. Is it more than my cost of carry? If it is more than cost of carry, then it is important to maybe better to buy the spot month and roll it every month. But if it is less than cost of carry, it is always better to buy the forward month if you are a hedger. Yeah, what is a hedge ratio? Because now we are getting a little bit into the technical aspect of it. देखिए, अगर हमने सोयाबीन मील बेचा है, today we have sold 5,000 tons of soybean meal. I will explain it from both sides. We have sold 5,000 tons of soybean meal in export market for November delivery. Okay, today rupee is at 74.50. I have sold it calculating it basis 74.50. And I have sold it, let's say, for $400 per metric ton. मेरा total exposure है $2 million का. Okay. Now I have sold 5,000 tons of meal at $400. My exposure is $2 million. I am going to get these dollars in November. लेकिन अगर उस समय रुपया 72 हो गया, that means I will lose money because I have done my calculation of export basis 74.50. So I sell dollars against at that price, okay? Because I know I'm going to receive dollars in November, okay? I sell dollars for November at 74.50. I hedge my risk. Similarly, if I'm an importer, okay, and I know कि मेरे को सोयाबीन मील अर्जेंटीना से आना है, it is going to come in September second half. Today rupee is at 74.50, or I have done my calculation basis 74.50 multiplied by $550 plus duty. It is delivered my plant at 49,800 rupees. लेकिन ये रुपये अगर 80 हो जाता है तो आपका कॉस्ट 5,000 रुपया 50,000 रुपया पर टन नहीं 55,000 रुपया पर टन हो जाएगा. To recover or take care of that kind of escalation of cost, what I need to do? I need to buy dollars, okay? So that when my obligation to give dollars comes, I don't have any adverse impact of it. अब मान लीजिए $2 मिलियन के अगेंस्ट मैं कहता हूं कि मैंने केवल हेज लिया है $1 मिलियन का, तो my hedge ratio is hedge value, that is $1 million divided by my total position value, that is $2 million. तो मेरा hedge ratio 50% है. अगर आप महीने के अंदर 5,000 टन सोयाबीन इस्तेमाल करते हैं और उसके अगेंस्ट आपने 2,000 टन खरीद के रख लिया है, तो आपका हेज रेशियो 40% है, दैट इज 2,000 डिवाइड बाय 5,000. इट इज वेरी सिंपल कॉन्सेप्ट, वी डोंट हैव टू गेट कंफ्यूज्ड विद इट कि हमारी टोटल एक्सपोजर कितना है, उसके अगेंस्ट हमने कितना हेज लिया है. मान लो मेरे को 5,000 टन मक्का पर मंथ इस्तेमाल करता हूं, मेरे वेयरहाउस में 2,000 टन है, आई एम हेज फॉर 40%. मान लीजिए मैं, and similarly we have to define it for every commodity. We don't have to be 100% hedged, but we have to be optimally hedged, and that comes from hedge ratio कि हमको कितना hedge करने की जरूरत है. शॉर्ट हेज होता है जिसमें हम हेज करने के लिए फ्यूचर्स पे शॉर्ट पोजीशन लेते हैं. फॉर एग्जांपल आई एम अ फार्मर, मेरे को पता है कि माय क्रॉप इज गोइंग टू कम इन अक्टूबर. सोयाबीन फ्यूचर इज ट्रेडिंग एट 64 rupees, and I believe that I need to sell certain quantity of my crop at 64,000 rupees. I take a short hedge. Price looks good to me. I sell 50% of it. I sell futures against it, and that's where I have taken a short hedge. And for example, the processor, they are always short. They need to buy. They need to take hedge, which is a long hedge, because they need to buy futures to hedge their risk. And you believe that 64,000 rupees is a good soybean price for October, you go and buy the future. Suppose I am an importer, I have imported soybean. The best hedge for me is to go and sell soybean future against it if I have already not sold that cargo in the physical market. The point I'm trying to say and staying on this slide is आप हर commodity को के प्राइस को हेज कर सकते हैं as long as you understand कि आपको कितना हेज करना है, किस टाइप से हेज करना है, आपको हेज करना है नहीं करना है, आपका रिस्क पॉलिसी क्या कहता है. हेज करना है नहीं करना है इज नॉट अ ऑप्शन. इफ यू आर अ प्रोसेसर, आपको हेज रेशियो डिफाइन करना है कि कितना करना है. डोंट डू 100%, स्टार्ट विद 20% कि ओके कि मेरा साल का आई नीड 200,000 टन ऑफ कॉर्न, 2 लाख टन की रिक्वायरमेंट है. आई विल बाय 40,000 टन ऑफ कॉर्न एट हार्वेस्ट during these months. Historically, I have faced crunch during these months, okay, and this is the harvest month. I'm going to buy at these locations. Then at least you will be 20% hedged against the situation. So the hedge ratio is to define for yourself कि आपका कितना percent portion of the risk covered है. That is your hedge ratio. Then I have already explained it in detail. So हमको hedge ratio define करने की जरूरत है. How we are going to do it. The second important concept I want to take you through is the cross hedge. हम बहुत बार बोलते हैं कि इस कमोडिटी का तो फ्यूचर ही अवेलेबल नहीं है, कॉन्ट्रैक्ट ही अवेलेबल नहीं है, मैं इस कमोडिटी को कैसे हेज करूं. तो उस कमोडिटी को हेज करने का तरीका होता है क्रॉस हेज. मान लीजिए आज सोयाबीन मील का फ्यूचर बहुत एक्टिव नहीं है, बट आपका सोयाबीन और सोयाबीन ऑयल के फ्यूचर्स अवेलेबल है. मान लीजिए आप सनफ्लावर मील आपको आप ट्रेड करते हैं और सनफ्लावर मील का फ्यूचर अवेलेबल नहीं है, लेकिन उसका प्राइस सोयाबीन के साथ चलता है, तो यू कैन हेज योर सनफ्लावर मील ऑन सोयाबीन. मान लीजिए आप सनफ्लावर ऑयल खरीदते हैं और सनफ्लावर ऑयल का कोई फ्यूचर अवेलेबल नहीं है, लेकिन सोयाबीन ऑयल का है, तो आप सनफ्लावर ऑयल के प्राइस को सोयाबीन के ऑयल के प्राइस से कैसे हेज करेंगे? उसे क्रॉस हेज बोलते हैं। यूजली लोग क्या करते हैं, वो ये सोचते हैं कि मेरे पास 1000 टन सनफ्लावर ऑयल है, लेट मी सेल 1000 टन सोयाबीन ऑयल एंड आई एम हेज। नो, इट इज अ रॉन्ग वे। कोई भी कमोडिटी का हेज क्वांटिटी से नहीं होता, प्राइस और क्वांटिटी से होता है। तो आपको पहले ये समझना है कि उन दोनों कमोडिटी के भाव में क्या रिलेशन है। फॉर एग्जाम्पल, आई एम नॉट टेकिंग यू थ्रू द मैथमेटिक्स ऑफ इट। मैं ये बोल रहा हूं, अगर वो दो कमोडिटी, मान लीजिए सोयाबीन ऑयल और सनफ्लावर ऑयल का प्राइस रिलेटेड है, और फॉर एग्जाम्पल आपका मेज का प्राइस इज रिलेटेड टू व्हीट प्राइस, और हमारा सोयाबीन मील का प्राइस इज रिलेटेड टू सोयाबीन प्राइस, हमको फर्स्ट ये समझना है कि उस हमारी जो दो कमोडिटी हम एनालाइज कर रहे हैं उनमें रिलेशन है या नहीं है। अगर उन दोनों में को रिलेशन है, दैट मीन्स दोनों का भाव एक दूसरे से इंपैक्ट होता है, देन हम एक कमोडिटी के थ्रू दूसरी कमोडिटी को हेज कर सकते हैं। ये मैंने एग्जांपल लिया है कि सोयाबीन ऑयल का फ्यूचर हमने प्राइसेस निकाले, उसका स्टैंडर्ड डिविएशन क्या है, उसके थ्रू अगर हमको सनफ्लावर ऑयल को हेज करना है तो वी कैन वेरी इजिली डू दैट। हमने इस एग्जांपल में ये दिखाने की कोशिश की है कि सोयाबीन ऑयल और सनफ्लावर ऑयल के अंदर 82% कोरिलेशन है। दैट मीन्स अगर सोयाबीन ऑयल का भाव 100 रुपए से बदलता है तो सन का भाव 85 रुपीज 82 रुपीज से बदलता है। तो और उनके स्पॉट और फ्यूचर की स्टैंडर्ड डिविएशन क्या है, उसके हिसाब से मेरे पास अगर 100 टन सोयाबीन ऑयल है तो मेरे को केवल 65 टन सनफ्लावर ऑयल हेज करने की जरूरत है। दैट मीन्स to hedge 1000 tons of sun oil, I just need to hedge 650 tons of soybean oil. और उसके लिए that takes care of my price risk. एंड दैट इज वेयर मैं इस एग्जाम्पल के से आपको मैथमेटिक्स से कंफ्यूज नहीं करना चाहता, मैं आपको ये समझाना चाह रहा हूँ या एक्सप्लेन करना चाह रहा हूँ कि आप किन्हीं भी दो कमोडिटीज को आपस में उनके प्राइस रिलेशन के आधार पे हेज कर सकते हैं, एज लॉन्ग एज यू अंडरस्टैंड कि उनके में क्या रिलेशन है और दोनों के स्पॉट और फ्यूचर के भाव कैसे चेंज होते हैं। वंस यू हैव नंबर्स, you do a simple mathematics, you can define a good formula to take care of your commodity risk, उन कमोडिटीज का भी जिनका फ्यूचर कॉन्ट्रैक्ट अवेलेबल नहीं है। देन टू से कि हमारे पास राइस ब्रांड का फ्यूचर अवेलेबल नहीं है या इसका नहीं है, एक्चुअली यू नीड टू फाइंड अ टूल दैट प्रोटेक्ट्स यू इंस्टेड ऑफ मेकिंग अ एक्सक्यूज कि ये नहीं है। एवरीथिंग कैन बी डन, ओके, यू जस्ट नीड टू डू bit of research, put a good risk management philosophy, have a good risk understanding, and you can make your purchase prices year round consistent. Okay, I'm not saying consistent without volatility, but the point I'm saying, you can put a carry to it, you can define that what will be my tomorrow's price will be through a good risk and hedging mechanism. There are two kind of hedges as we have discussed, a long hedge and a short hedge. Long future hedge is when you purchase a asset as we define, एक प्रोसेसर को asset purchase करना पड़ता है, जबकि एक फार्मर को शॉर्ट हेज करना पड़ता है, उसको बेचना पड़ता है फ्यूचर को अपने आप को हेज करने के लिए। अगर हम दुनिया भर में देखें जो फ्यूचर कॉन्ट्रैक्ट है उसमें सबसे ज्यादा लिक्विडिटी दो लोग लेकर आते हैं, वन इज फार्मर एंड सेकेंड इज प्रोसेसर। एंड इंटरेस्टिंगली इंडिया में दोनों ही बड़े पार्टिसिपेंट नहीं है, ओके, एंड दैट इज वन ऑफ द मेन चैलेंज दैट वी हैव टू ओवरकम as processor will come with the advent of FPOs and good option contracts with exchanges designing, with the coming of the put contracts, okay, put options, you will see there will be a bigger participation of farmer in the coming days. There will be a bigger participation of the mutual funds in the coming days, which are going to make these future contracts very liquid. And as a processor, it is imperative for us to have our presence on the futures exchange. And that takes us to to understanding of basis, because we have till now, let me maybe summarize the situation till here. We have understand what is futures contract, what is spot market, what is futures market, what is hedging, what are the different kind of hedges, what is a long hedge, what is a short hedge, hedge ratio, and how we can hedge various commodities. हमने ये भी समझा प्राइस क्या है, हमने ये भी समझा स्पॉट मार्केट क्या है और फ्यूचर मार्केट क्या है. That takes us to a very important aspect. What is basis? Basis is the difference between cash price minus the future price. आज हमारा मान लीजिए in India or at certain places we look at let's say कि for example a soybean in Akola is 5,000 rupees. On futures it is trading at 5,200 rupees. 200 rupees is our basis. It is our local cash basis जो आपकी लोकल डायनेमिक्स को एक्सप्लेन करता है. जो फ्यूचर कॉन्ट्रैक्ट है वो आपके मैक्रोस को रिप्रेजेंट करता है कि भारत में क्रॉप कैसी है, सिचुएशन कैसी है, क्रॉप ज्यादा है कम है, क्रॉप ठीक टाइम पे आ रही है नहीं आ रही है, लोगों की डिमांड ज्यादा है कम है, ग्लोबल सप्लाई डिमांड सिचुएशन कैसी है. जबकि एक बेसिस आपके लोकल कंडीशन को एक्सप्लेन करता है कि आपके अकोला मंडी में माल आ रहा है नहीं आ रहा है, आपके कोटा में माल आ रहा है नहीं आ रहा है, आपके दावनगिरी में कौन आ रहा है या नहीं आ रहा है, आपके आप यूपी के अंदर गेहूं आ रहा है नहीं आ रहा है. सो बेसिस डिफाइंस योर लोकल डायनेमिक्स. So basis risk is your local risk, while future risk is your macro and the commodity risk. So you take care of, you diversify your macro risk, your commodity risk by using futures. While is the basis is a very local risk that you always have to assume. वो आप चाहे फ्यूचर हेज करें या नहीं करें वो आपके साथ हमेशा होगा. But by understanding futures, you will have a better understanding of your basis risk, and that in itself make you a better risk manager. Okay. And that is where we have defined कि future के expiry के time पे we expect both futures and spot contracts to converge, and that is where the convergence takes place. And that is where basis risk को करने के लिए there are few challenges which will always be there. You cannot risk mitigate it, but you can understand it, and you can employ it in a better fashion to your advantage. Once you will have good numbers as a background, you will be able to use basis risk to your advantage. It will no more be a risk, it will be more of a facilitator for you to understand your futures better. Just to give you example here of the basis risk when the market goes up. Okay. मान लीजिए आपका कैश मार्केट आज 5,000 रुपया, 55,000 rupees is there, and the future market is 56,000 rupees. Okay. And what you have done, you have bought your cargo at 5,500 rupees and you have sold future against it. There is a basis of 1,000 rupees. In November, what happens? आपको लगता है नहीं, now I have to unwind. You can sell your futures against I mean you have bought the futures against it, you can sell your futures against it, and you can sell your buy your physical against it. तो अगर आप कंज्यूमर हैं, आपका सोयाबीन जुलाई में 5500 था, जो आपने फ्यूचर पे 5600 पे हेज किया, 56,000 रुपए पे हेज किया, इन नवंबर फिजिकल 60,000 रुपया हो गया एंड फ्यूचर इज 61,000 रुपीज. टेक्निकली आपका बेसिस 1,000 रुपीज रहा. आपका जो फ्यूचर मार्केट में जो गेन था has offsetted जो आपका physical market में loss हुआ. Loss which is a notional loss because I'm saying because you have already hedged yourself technically. Okay. So what it entails, that means आपका जो buying price है आपके लिए, you fix yourself at 55,000 rupees. Okay. And that is where a role of a consumer, a good purchase manager in the physical commodities come into picture. चाहे बहु ऊपर गया, physical markets have gone up, but you have taken care of your interest by hedging yourself in the future market. This is an example of long hedge, and usually long hedge is done by the physical players, processors. When prices goes down, there can be a situation where you are a physical, you're a consumer or you're a processor, and you have bought your soybeans on future at 56,000 rupees, but prices goes down, okay, to 51,000 rupees. अगर आपके पास फिजिकल में भी मटेरियल होता तो आपको 5,000 रुपीज का फिजिकल में ऑफसेट होता, which even is reflected by the future market. But आप इसको लॉस ऑफ प्रॉफिट की तरह मत देखिए, but see कि आपका 55,000 रुपीज के ऊपर आपका प्राइस फिक्स हो गया है. आपका पिछले केस में भी प्राइस 55,000 रुपीज के ऊपर फिक्स हो गया था when market went up to 60,000 rupees in cash market. And in this case also, your price and supply got fixed at 55,000 rupees, even if market has gone down. You may ask, why should I take a hedge when prices have gone down? Because you are not sure what direction prices will take 4 months down the line. Price change every moment. And when you are a processor, you need a security on certain percentage of your supplies. And that is where you need to do hedging. And that is where it is important to understand this. There are certain cases where even basis changes. मान लीजिए आज आपका basis जो हमने फर्स्ट केस में एक्सप्लेन किया वो 1,000 रुपीज goes down or goes down. What does it mean? कि आपका कैश मार्केट बहुत तेज नहीं हुआ, फ्यूचर मार्केट हैज गॉन अप फास्टर. दैट मींस आपका बेसिस वीक हो गया, लोकल बेसिस इज वीक. दैट मींस you will make money on your hedge. That means your purchase cost has gone down from 55,000 rupees to 1,000 by 1,000 rupees to 54,000 rupees. What is more important here to understand? Just one second. Just one second. Hello. This one and the one. Oh, when? I think so. I can see. Just ask someone else if they can see me. Is it okay? Hello? May I continue? Anji ma'am. Okay, I'll continue. Sorry. Okay, thank you. Sorry, there was a network issue. We thought I got disconnected. So I'll continue from here. Thank you. So as we have defined till now, is the aspect of basis. Okay, we have to understand basis to understand our local dynamics. Okay, and that is where basis risk tracking and evaluation is important. वो आप कर सकते हैं, आपके पास भाव की हिस्ट्री है, फ्यूचर्स की हिस्ट्री है, you can define basis, you can make chart for yourself कि basis कब ऊपर जाता है, basis कब नीचे आता है, and that is where people employ various strategies. One is the technical aspect of it. Second is fundamental. Certain people use techno fundamental. In fundamentals आप supply and demand देखते हैं, local S&D देखते हैं, आप ये समझते हैं कि मंडी कैसे चल रहा है, अभी तक कितना supplies आगे आने वाला है. In case of technical, you look at charts, आप history देखते हैं, you evaluate history, then you go to the algo or the mathematical part of it, then you define the risk in or the prices into mathematical terms, और उसके around risk को define करते हैं, और ये देखते हैं कि how it is going to pan out in future. Past models आपको future prices को कैसे define कर रहे हैं, and you use various spreads, commodity spreads, inter-commodity spreads, calendar spreads. Then you globally use inter-exchange spreads. Okay, you look at seasonality of the commodity कि ये कौन से महीने में इसके भाव नीचे जाते हैं, कौन से महीने में ऊपर आते हैं. Generally it follows a set pattern. Harvest पे usually prices नीचे आते हैं, and during the off months you have a carry. Mean reversion की जब भाव बहुत ऊपर चला जाता है, it has a tendency to come towards mean, and that's where you run the you do the mean and averages around it so that you understand, okay, is it going too fast, too soon. Then you do the relative value trades. For example, आप बाजरा और मक्का दोनों इस्तेमाल कर सकते हैं. लाइक आपने देखा कि आपकी लोकल मार्केट में मेज के प्राइसेस बहुत ऊपर जा रहे हैं, लेकिन बाजरा के भाव अभी तक ऊपर नहीं गए. आपको हिस्टोरिकल अंडरस्टैंडिंग है कि मेज एंड बाजरा प्राइसेस दे मूव इन टेंडम एंड दे मूव टुगेदर, एंड दैट इज वेयर that means bajra has become cheaper against maize. So you can buy bajra and sell maize in the futures against it. And that means you have hedged yourself against the volatility of the maize prices of the future. क्योंकि अगर maize का भाव ऊपर जाएगा, बाजरा prices may also go on. Okay, and that is where you can use the risk management or understanding of the various risk measures. If you have a clarity कि basis क्या है, physical price क्या है, future price क्या है, how these commodities are connected to each other, इनका seasonality क्या है, various seasons में इनका relation क्या है, how how the how they have behaved in the past, what is industry doing. Always look at your customer's customer. मान लीजिए मैं एक सप्लायर हूँ, रॉ मटेरियल सप्लायर, और ऑलवेज हैव टू सी कि मेरा जो कस्टमर है विच इज अ पोल्ट्री प्रोड्यूसर, उसका एंड प्रोडक्ट का प्राइसेस कैसा कर रहा है. इफ हिज एग प्राइसेस आर गुड, that means his realization is good, that means he will pay me faster. And that is, these are the various ways you use various aspects of your business, you risk manage various aspects of your business. And that is where I am maybe taking a subjective approach, and I am requesting each one of us, please start putting all your matrices in mathematical numbers up, do a proper record keeping, make the history of prices. You can use it in various ways. You can use it in such a way that will surprise you कि अरे मेरे को इतना benefit हो रहा है मेरे data से. What is more important हमारे लिए, exchange provides us so much data. Please download, take their information every day. Please keep your record of the future prices so that जब आपको refer करना हो, you can go back and see कि last year August के अंदर maize prices कैसे change हुए थे. How the spot prices of last 5 years have changed in गुलाब बाग मंडी. आपके पास spot prices exchange के exchange website पे usually available होते हैं. And once you start making your decisions not by hunch or not by only the requirement, but by having a good budget in front of you, a proper analysis of how commodity can surprise me, how I have to make sure that I don't get surprised by the price movement, rather I am in line with the direction of the market. It will give you a better control over your day-to-day life, and that will make our job as a consumer, as a processor, much more enjoyable, because today we get surprised by any upward movement. Again, the point I'm saying, we don't need to. It is a commodity. Why it is named as commodity? क्योंकि इसका कोई product का price fix नहीं है. It is a commodity because it changes every day. It depends on the expectation. You cannot control it. Just to give you idea, last year soybean prices in US moved up from 850 cents per bushel to 1700. It went up by 100%. It went up by 100% in India also. But why our industry got shocked? Why our industry got on the wrong side of the supply? Because we were not prepared to take care or insulate ourselves against this kind of adverse price movement for a consumer. A farmer must be happy with this kind of movement. Okay, and that is where the point I'm trying to bring us to various slides is, please do not look as a price movement as the only tool. Please see कि हमारा को requirement, that how I need to take care of it, how I need to prevent it going against my expectation. What tool should I employ? Should I go physical long or should I go exchange long? Should I, if I'm physical short in physical commodity as a processor, do I need to hedge my futures from the long side, or do I need to buy calls? So these are the decisions over period of time as India will become, because of our processing, our consumption is going up. As we have to become a $5 trillion economy, either our domestic production has to go up drastically or will become import dependent. And whenever we'll become import dependent, if we become import dependent, then what will happen? Our prices will be dependent on international factors. It will not be dependent on local factor. And what does it mean? That you need to understand what is happening globally, what is happening in Chicago, why the prices are, what can entail those kind of movements. Or when we cannot understand, no one can understand those movements, then as a consumer, as a processor, we need to take a directional view that I cannot understand price, but I need this supply. At this price, I'm safe for the year. Historically, my margins have been protected at this kind of value. So So you need to have a proper policy in front of you, a proper risk assessment tools in front of you, and good risk hedging tools, that is futures and options in your toolkit to use so that you can use them optimally at the right time. I've just taken an example of what is board crush. I know each one of you understand board crush. That it is not important to have a crush plan to hedge yourself for soybean meal. You have soybean futures, you have oil futures, okay, and you can very well hedge yourself for soybean meal prices by using these two tools. You can be long board crush, you can be short board crush, okay, you can trade the board crush, okay. The point I'm trying to bring through various slides, the presentation we will share with you, is look at the tools and how we can use it. For example, I need meal, I can be long beans and I can be short oil, so I'll be long soybean meal. I can cover myself for the months to come only using these two tools. I have soybean in physical, I want to take care of the risk, I can just sell oil against it and then I can be long meal against it, okay. So you can use various aspects of this risk management toolkit to minimize your risk, to use the futures and option contracts which can give you multiple results around a same variable. I mean, which can help you design multiple results according to your requirement. And that is where to use the future toolkit, the understanding of these tools and these aspects of trading has become mandatory for all of us. And that is where maybe I'll spend 5 minutes on this slide, which is very subjective in look, but it is what is risk management is. A lot of people, they come and they say, oh, last year was very good, I made money. Okay, you made money. Why you made money? That's the question. Oh, look, I was long 5,000 tons of beans and market went up and I made money. Okay, next year he comes, let's say next month he comes and says, oh, it was a very bad month. I lost money. Why? I had 5,000 tons of beans and market went down. So is it what you want to do? It is just depending on the macro factors, on luck, on luck, goddess fortuna to bring you money or take away it from you, okay. Result oriented traders miss important learning opportunities. They tend to look at only the result, whether I have made money.
Voice is gone again.
Is
You're
it
not.
better now?
Yes, sir. Yes, sir.
Yeah, whether I have made money or lost money, whether rather you should look at the process, that what is my risk management policy. I need to have a hedge ratio of 30%. Whether I have taken a hedge of 30%, yes, I have taken a hedge percent 30%. Then does my hedge went with me or against me, or what was the net result of it? Is it the current price, uh, is it okay now? Can you hear me? Is it audible?
Yes, it is audible to me, sir.
Yeah, okay, perfect. So second is to have a risk management policy, risk tools, and a proper understanding of those tools around it. Okay. Do I have a hedge policy? When I need to hedge, what commodities I need to hedge? What is my hedge ratio? Whether I have done it in a right way? Yes, I have done it in a right way. Then what learnings came with it? Did I follow the seasonality map with it? Did I follow the proper hedging tools? What can be the better option or derivative tools I can use? If you go by the process, you will improve every season. And once you will improve every season, your incomes will become more consistent. Your supply purchase price will become less violent or less volatile. And what does it mean? You can do a much better planning for the raw material and the processed products. And you can do long-term contracts. I will give you an example here of malt industry. Okay, historically, world over, they go for 6 months flat pricing. For example, they give on March 1st, April 1st, they give prices for next 6 months. Or on October 30th, they give prices for next 6 months. Do you think without having a proper risk management tool, they can do it? Answer is no. And that is where these commodities, which lead long-term prices, for example, your customer may ask you for 3 months of supply contract. You need to, once you do a forward price planning, you need to do a proper risk management planning of your commodities or inputs to hedge your profits. For example, you must have heard about Ray Dalio. and his book's principal. He is one of the very big hedge fund guy and a PE investor, Bridgewater's Capital. They have designed a tool for McDonald's in 1983, 1984, when McDonald's wanted to launch their chicken nugget burger in US. Their demand was so huge that they were concerned that they cannot launch this product because they cannot hedge the prices of chicken. And the tool designed for them was very simple, that you need 55% of corn, 25% of soybean meal, and day-old chick prices. You can hedge 80% of it by going long futures of corn, going long futures of soybean, and and do a tolling arrangement with someone with whom you provide the raw materials, and he will give you a fixed conversion fee. So what is more important, I want to tell you that future and derivative contracts gives you a tool where you can divide an entire problem into sets, which you can do a actionable, where you can have an actionable statement, where you can go and take certain decisions. You can go and take certain actions on it. And that is where, don't look at a problem of purchase or processing as one problem. Divide it over various commodities. See which commodity I can hedge, which commodity I can cross hedge. Why should I do it? How it will impact us? And second, once we'll start doing it, I will maybe take an example of China also here. In China Shanghai exchange was not a big exchange till 2010. Today, 90% of the physical business happened through Shanghai exchange. No processor, no consumer, or no processor, or no processing plant, no manufacturer can become big till the time they start hedging their risk, because the return can only be measured as a risk adjusted return. If you will not hedge your risk, you are taking 100% or assuming 100% of the risk, which is not an optimum way of managing your P&L. And that is where, as a country, if we have to look at Make in India, if we have to make our country a $5 trillion economy, if our country is going to grow by virtue of population and by virtue of consumption, then our price situation in India is going to become very volatile, because our stock to use ratio are going to go very low. We are going to potentially, again, don't hold me for this, import dependent, which nobody wants to hear. But yes, if we don't invest in technology of seeds, we are going to become import dependent. And that's not my view. I'm just giving a direction to it. Okay. And that is even, or let's say we don't become import dependent, we export the way we are exporting at the moment, let's say of corn and meal. Even then we are linked to international market. We'll keep exporting till the time we are cheaper than international market. We have to price ourselves out every year of the market, and that's where Indian consumer will always be on the wrong side. And that is where it is important to understand for all of us that we are living in a globally connected markets, and we as Indian manufacturers, processors of feed or animal or other products cannot isolate ourselves and say, I will not hedge. We will isolate ourselves in the global markets, and better organized companies with better risk management policies will expand, because they will assume less risk by proper risk management practices, and they will have more bandwidth to expand their operations. And that is where, for every entrepreneur who wants to make big, who want to expand, need to palm off their risk to somebody else, the one who can assume and take the and use the risk more effectively. So to come to the last part of it, I will say today we have covered the basic aspect or other aspects of basis, physical market, future market, cross hedge, commodity hedge, hedge ratio, various tools to use it, what is price, future market, spot market, what is the relevance of it, global markets, and how we need to have a risk management policy in place, various tools we can use in the risk management policy, why we need to be process oriented than result oriented. And that takes me to my last slide that says the pace of change within our lifetime is going to become very big. Why this slide is important? Because telephone took 120 years to become popular. Okay, and cell phones, that is mobile, only took 10 years. That means the pace at which things are changing is becoming very fast. The pace at which prices will change will become faster. The pace at which companies will come and go will become faster. Which companies will survive? Only those companies will survive which have better risk management policy in place. The companies which have a guidance, the companies which can stand the test of time, the companies which will be able to understand that how I have to guard myself against unwanted risk. Please don't please differentiate. I'm not saying you have to give up 100% of risk, because then you cannot make money. You have to assume the right risk. You have to assume and palm of the risk which you can. You have to see where I can capture my margin and smoothen my curve of P&L. And that is where, to have a longevity in our businesses, for everyone, it is important that we assume right risk, we assume optimum risk, and for balance, we use right risk management tools, risk management practices, and have good tools around it. We have to make our decision making mathematically oriented. We need to have all our databases in place. We should use seasonality, other basic tools to take our decisions, which can be intuitive most of the time, but sometimes having it front of you always help. And uh, and that is where I will like to put it in perspective that let's hope that all of us are going to survive, our businesses are going to survive for a very long period of time, and we are going to do it with on back of our understanding of the markets. Let us make it as the entire function as a game of skill, not as a game of luck. What is a game of skill means? Where you have optimum skills to manage your P&L, to manage your outcome. And when we are only dependent on the macro factors, we are only dependent on God to help us, okay, then it is a game of luck. And futures is not a game of luck. Our businesses are not game of luck, they are game of skill. And let's welcome various risk management and derivative strategies. Let's use them, and let's imbibe all this as our daily routine. And that is where I will say this, financial literacy is a very important, derivative literacy is a very important aspect that we need to have in our businesses, in our colleges, and in our, as a function that we need to understand the investment part of it. And that is where I will like to thank platforms like NCDX, where they are using the platforms to pass on the learnings which NCDX has over the years. And I hope I have done justice with the time of the participants, because you all have invested 90 minutes of your precious time. And I'm open to questions. Feel free to ask any question.
Thank you so much, sir. I request all the participants, industry participants, to ask your questions. Sir is here. Make the most of it. Anything that he has discussed, I think he has given a very good detailed understanding of why one needs to manage the risk, why one needs to understand the movement of price, and how it is important how why it is important to manage the price for our business. So if anybody has any queries, I'm sure sir will be very happy to answer your queries. Sir, we have one question.
Yeah.
How does one decide a hedging ratio? Is it based on risk? It's based on risk appetite, right?
It's a very important question, because once you have to put a hedge ratio, you have to understand the risk. Okay. You know, I will say uh, there can be various mathematical measures for it, but I'm not going into it. Okay. Or one doesn't need to go into it in depth. what is more important, one should begin with, let's say, the commodities which can be hedged. One should have an outlook. Okay, whether it is a big risk or a smaller risk, it is important to understand the risk management or risk associated with it, or the volatility associated with it. If the volatility is high, then you need to cover yourself adequately. That means if, for example, INR rupee, if it opens 80 rupees on one day and goes back to 75 and opens at 65 rupees next day, then you need to hedge yourself 100%. You need to have a higher hedge ratio. But if the commodity is less volatile historically, okay, its standard deviation is very low, let's say, then you can have a lower hedge ratio. That means you can hedge yourself for 30, 40, 50%. Okay. So it depends largely on the volatility of the product, okay, and your risk management philosophy around it. To define a hedge ratio for a company, there is no standard cast in stone answer for it that you should do it 100%. You can do anywhere between 10% to 90%. Okay, and depending on how that risk impacts you, and what is the volatility, quantum, and impact of that risk on your business. Hello.
Yes, sir. There's a continuity. There's a continuation to that question.
Okay.
Yeah.
What's the question, ma'am? I can't see actually on my
It's in
chat
the chat.
menu.
It's in the chat actually. For example, in covering soybean meal, there are two legs or two determinants. One is the seed itself, and the second is the crushing for oil. How does one manage covering soybean meal purchase? When to hedge, and what is the manner of hedging for upcoming 2 to 3 months? Like when to enter and when to exit the market, when to buy and when to sell is basically the question.
Look, when you are hedging, the question is not when to hedge and when not to hedge. There are two questions: how much to hedge and why should I hedge? What is your
So
risk
sorry,
management?
there are two different questions from two different participants.
Okay.
The first one is the soybean meal. I mean the
Yes, yes.
determinants.
I will take it in a continue. I will build the story around it. Okay.
Okay.
Okay. So the right determinant is not the direction of the market. That you look, you can start timing it, but that comes later. The first step is always is to have a risk management philosophy around it, or a method around it. That okay, I have a 5,000 tons requirement every month. I need to hedge 2,000 out of it. That means I have a hedge ratio of 40% irrespective every year, every month, month on month. Okay. Now, for example, today in India, soybean meal contract is not very liquid. Okay. Now, what are the two liquid contracts against it? Soybeans and oil contract. So when you buy, you can buy soybean for next 3 months, okay, or next contract is for next 3 to 4 months. You can buy soybeans on futures. You can sell oil because soybean has two determinants, that is oil and meal. You can sell the oil in the future or physical market wherever you find it liquid. Okay, so you become long technically meal for your plant. So you have covered your price risk for meal for the next few months by hedging yourself, or by taking position on the bean and the oil contract in futures or physical. So that is where you can price risk, or you can hedge yourself against the volatility of the meal prices by going long, or by taking position in the futures contract. And similarly, a crusher can do the opposite of it and hedge their crushing margin by doing it. So one tool is giving a meal hedge to a feed manufacturer, and same tool is giving a hedge to a crusher to lock in his board crush. So the point I'm trying to drive is you can use, even in the absence of soybean meal as a future contract, you can use soybean and oil contract to guard yourself against the volatility of soybean meal prices. Hope I have answered the question, hopefully.
Yes, sir. The second question was when to hedge. I mean, the pattern of hedging for the upcoming 2 to 3 months. How do you plan your hedge for the next 2 to 3 months?
Okay, on this question, I will say when you are hedging, okay, don't look towards the timing of hedge first thing. Again, okay, don't first define the quantum of hedge you want to take. Okay, and once you have defined the quantum of hedge, then you need to define the historical basis around it. Okay, and once you understand the seasonality, usually as a processor, don't look at the direction, only define the quantum and roll your hedge every month so that you are covered for a certain optimum number month on month. And once you will start differentiating between hedging and speculation, on which we have spent some time, you will be able to define that what I have taken as a hedge is to protect me against the adverse price movement. And that is maybe 20-30% of my total requirement. Okay. Again, maybe I'm not able to say it with authority that don't look at the timing of it, but make a policy. Do it as a quantum, like 20% of my requirement, but do it consistently month on month. Okay, it will give you result over 3 months, 6 months, 1 year. It will not give you result on day one, because usually we start comparing our hedge with PNL, and that is not the intent. Okay, and that is where please do not look at the direction that market will go up. I should hedge at this time. Okay, you have to look at your quantum, what you need to hedge. Okay, you have to look at the quantum, your hedge ratio, rather than at the timing of. Is it
Yes, it is. We
yeah,
have Mr. Vidya Sagar from Jaffa Feeds actually.
okay,
It was in continuation to his earlier question, wherein he had asked about hedging of soybean with the determinants, that soybean meal and soybean oil.
yeah.
So, in continuation to what you had, answered his question, he has stated two more statements. As in, do you mean that the company which buys only a soybean meal, the company should cover both oil and bean without any underlying physical quantity? Will this not mean a risk of non-delivery at the time when contract comes up for execution? Probably an example could help. He's a little bit confused.
Okay. Look, when we are looking towards hedge, we are looking towards a price risk management. Okay. And when we are looking towards delivery, we are looking towards supply security. Okay. The functions of the futures is to converge, and when you reach a expiry of a particular contract, you need to roll your hedge forward, depending on for how long you need to hedge. So that is where I don't think you get into a trap of non-delivery. Okay, or you don't need to look at the delivery as a hedging, or delivery or non-delivery as a mechanism to your hedging strategy, because you are looking towards price risk management. And once you know that, or once you start rolling your hedge, or you can roll it forward, or you can close it by physical buying, you don't need to get into delivery aspect of it. Okay, so I don't think delivery adds any kind of risk to it. The only point is, again, we have to mentally differentiate that I am not getting into physical deliveries with exchange. I am using exchange platform for price risk management, not for the supply risk management. Okay, those both the functions are different. The function of the supply side management is for the farmer. Okay, for processor, usually you have to cover your prices in the local market, commodities in the local market, but it gets impacted by the prices of the futures contract which is traded on exchange. So use futures only as a price risk management tool. Okay, and keep it rolling forward till the time your hedge objective is met.
Yeah. Thank you so much, sir. Any more questions for Mr. Sumit, please? So we still have time. Probably we can take 2-3 more questions.
Or maybe I will, if you are okay, if there are no questions, I'll conclude maybe with anecdote or example how globally
Sure,
consumers do it.
sure.
Okay. Uh, for example, as I have given you example of McDonald's and Ray Dalio, how they have hedged their risk. Every flour miller, every processor, today there are Russian Black Sea swaps. Today, Indonesian flour miller, they buy Russian wheat through futures and they don't buy it in physical. Okay. They are buying next year wheat on Russian futures, Russian wheat futures, which are trading on CME. Now, does it mean they're taking a physical ownership of it? Answer is no. It means that they're buying the direction of the prices. Okay. That means they have bought the price. They know if the physical market will go up, future markets or swap will reflect that price. And once they will buy it physically, they will close out their future position. But the price for the miller is already locked and he has already sold noodles and bakery products and this thing in the forward contract to the retailers already. And in a country like India, as retail will get stronger, we will see they will ask you for the long-term contracts. And when there's those long-term contracts will come into picture, it will be imperative for you to have long-term supply contracts on prices. In physical, the contract sanctity is not there. While in future, your contract is 100% Puritan. It is 100% authentic and enforceable. And that is where we have to see these contracts and tools not only is what is happening today, but what is happening world over. We are living in a connected world and how globally other consumers within your company, how these tools are used. Because all the major manufacturers who are in India, their Singapore offices, global offices who are buying from South America, they're using advanced exotic options to have knockouts, to have a price security, price hedges on their all the buying operations. And that is where we need not to rediscover the tool, but we just need to bring all those global good practices to India and use it over Indian exchanges so that we can have a more vibrant and liquid exchange. Thank you.
Thank you, sir, and thank you to all my participants, especially to all the ones who have attended session 1 and session 2. And we will have the session 3, the module 3, next Saturday, same time, 10 to 12. We will share the flyer soon, and I request all the participants to register for the third session as well. I am hoping and that all the earlier session and today's session has been very productive for all of you, and hope to see you all soon trading on our exchange. And happy hedging to all of you. We'll see you soon next Saturday. Thank you, sir. Thank you, everybody. And we'll share the presentation with all of you once we complete all the 3 sessions.
Sure.